and welcome to a special segment after CPI numbers are out. This number is at 1.33% of the last month compared to 0.7% which was there earlier. In that, the food inflation has stood at minus 2.7%. If you compare with last month, it was minus 3.91%. The outlier for inflation numbers this time has been the core inflation number, which has come in at 28-month high of 4.6%. To discuss how the numbers have been and what it means for policy, we have with us Sakshi Gupta from HDFC Bank. Sakshi, welcome. My first question to you is regarding the core inflation, which has come in at 4.6%. How do you assess that?
Yeah, hi. Thanks for having me on the show. You're absolutely right that the headline core number, as you said, is at 4.6% and at a 28-month high. However, the primary reason why you are seeing this number is because gold prices have continued to kind of climb up. And just to recall, within the core basket, you have a category called personal care and effects, which is influenced by how global gold prices, move. So therefore, that is the reason why you're seeing this increase in core inflation. If you remove gold from core CPI, then you get a number which is close to 2.6%, which is very, very comfortable.
Right. But even if you think about the Reserve Bank's trajectory, the numbers are well within line. But if you talk about food inflation at minus 2.7%, similarly, the vegetable inflation has remained at minus 18.47%. Let me also welcome Indranil Pan. How do you read vegetable and food inflation numbers?
Vegetable prices has been the critical driver of the food inflation that has been happening for quite some time. In fact, what we actually see is that it's becoming very difficult for economists like us, and maybe Sakshi would also concur, in terms of trying to figure out what our forecast would be. Because neither the DOCA data nor the NHB data actually is showing any significant correlation between the actual release that is happening versus what is being evident in the mandi prices. So that's the disjoint that is happening, and we'll have to sort of follow the vegetable prices and the cereal prices quite closely going forward. Because if the vegetable prices actually turn, it can actually also turn quite sharply, and that can actually remain a concern going ahead. Having said, I think the headline CPI is trending up and is probably likely to continue to trend up for the over the span of the next financial year. RBI's estimate for the third quarter was 0.6% average. This is the average that has actually emerged is slightly higher than the RBI's estimate. And we'll have to see how the new index actually pans out.
All right, Mr. Pan, rural inflation, let's just talk about that. What specific rural demand indicators are you specifically monitoring closely after this data?
After this data, I don't know, but prior to the data, I think we were closely monitoring the retail vehicle sales as well as the sale of the two-wheelers, which had been sort of relatively on the slowing side, which tends to indicate that there may be some exhaustion that is happening already in the rural consumption demand. Urban consumption demand has, on the other hand, been relatively more robust, and we might actually continue to see a push in the urban consumption demand because of the monetary easing that we have seen from the Reserve Bank of India.
Right. Sakshi, how do you assess the data and vis-a-vis the forecast which has been given by Reserve Bank of India even for Q1 and Q2 of the next financial year? Do you think that especially next quarter is going to be a challenge?
Look, there are a couple of things that are happening underlying this inflation data, right? I think the inch up that you are seeing in December from the November print is happening because now the very, very favorable base effect that was also kind of pulling down the headline numbers is slowly going to fade away. So as we progress further into 2026, the base effect will start becoming very, very unfavorable, which will push up statistically the headline inflation numbers. And I think that is being mirrored in what the RBI is anticipating for Q4 and Q1, Q2 of next financial year. We have similar estimates. I think for Q4, we are estimating 2.8%. Again, here we are, factoring in that the favorable base effect the impact from that would be lower. I think momentum wise, I mean, I kind of agree with, Mr. Pan that if you look at some of the mandi prices on the food side, for the month of December, we actually saw a month-on-month increase in vegetable prices, but that is not getting reflected in this data on a month-on-month basis. So there seems to be some disconnect, but overall, at least on the food side, I think conditions remain favorable so far. So we are not expecting a major spike, at least for the next 2 or 3 months in the inflation data. Moreover, I think we have to remember that now until October 2026, there is also the impact of the GST rate cut, which will continue to play out and pull down some of the categories within core inflation. So even in this month, if you see, there are things like household goods and services, recreation and amusement, etc., where inflation is kind of trending lower on a YOY basis. And that I think is being influenced by the GST rate cut impact. So from that perspective, at least things are favorable. Look, at this juncture, to make conjectures about 2 quarters ahead or 1 quarter ahead forecast, of course, there's a fair bit of uncertainty on what those numbers would be, because now the next CPI release will be the new index with a revised base and a lot more other changes. So of course, we'll have to take a look at those to assess whether the inflation numbers for Q1, Q2 next year will be in line with RBI's projections or not.
Definitely, and 6th February is when MPC will be weighing on the policy decisions. How do you think this data will have an impact, Mr. Pan?
Well, I think this data, in my opinion, and as Sakshi also rightly pointed out, we are likely to see a new CPI number with a totally altered weighting diagram and composition, which necessarily means that the RBI would have to relatively wait and see what is the noise that is created around the current trajectory of inflation versus the new trajectory of inflation. The second is, I think growth is still holding out. Yes, the RBI has expressed some concerns on the growth front for the second half, but in my opinion, growth is not crashing down, which necessarily means that there is possibly no need of any incremental rate cuts to support the growth story. The third issue, of course, is the fiscal, which is expected to be continuing to support growth, and we'll have to see what are the various specific policies that come out in the fiscal in terms of the growth boosting measures. And that is something that the RBI will possibly also and the MPC will be taking into consideration. So my bet, no further cuts immediately to be priced in. And any further price or rate action by the Reserve Bank of India could actually heavily depend on the growth dimensions and more crucially, the growth dimensions rather than the inflation dimensions.
Right. Sakshi, I want to come to you for a similar question and adding that, do you think that 28-month high data of core CPI is a cause of concern too?
Right. To answer your second question first, I think, as I mentioned, it is happening because of gold prices. So if you remove that, the underlying momentum in core inflation is still very, very moderate, right? So CPI core inflation excluding gold is just about 2.55%, which is a very, very comfortable, I think, number. And as I also mentioned, you have the GST rate cuts that is also kind of helping to keep, the core inflation momentum rather moderate. So I don't see that being a major cause of concern at this stage. To your first question in terms of RBI outlook, I broadly agree. I mean, look, we are not expecting a rate cut in this policy. In the February policy, I think growth momentum, tracking a couple of indicators seems to be holding up and has held up beyond the festive season, which I think is an encouraging sign. And therefore, I think that the focus in this policy, and even perhaps even before the policy, I think from a market perspective and from the RBI's perspective really is in terms of managing liquidity, right? So I think that transmission of the rate cut that happened in the December policy, I think is more important at this stage. And therefore, I think all focus is going to be on RBI providing greater liquidity support, given that they continue to kind of intervene on the FX side and drain, liquidity from the system. So I think liquidity for now trumps, any rate cut expectations.
All right, Sakshi Gupta and Indranil Pan for joining us and dissecting the CPI data for us. Thanks again for joining us today.
Thank you.
Well, it is time for us to slip into a very, very short break. You don't go anywhere. We will be right back after this.